Here's the dark side of invest early. Invest often advice that no financial influencer will tell you because none of them profit when you save. You have $47,000 invested and still can't pay a $3,800 repair bill. That's not wealth. That's a trap nobody warned you about. And before this video is over, you're going to understand exactly why it happens, why it's more common than anyone admits, and what the correct order of operations actually looks like when you're building real financial security. Jake had $47,000 saved up. Every single dollar sitting in a brokerage account, invested across a handful of index funds and 2 individual stocks he believed in. By most metrics, people would look at Jake and call him responsible, disciplined even. He was 31, he had no consumer debt, he maxed out his Roth IRA every year, and he had built a portfolio most people his age would envy. Then his car's transmission died on a Tuesday morning. The repair estimate came back at $3,800. Jake had $47,000, and he couldn't pay for a $3,800 repair without selling something. He sold shares at a loss because the market had dipped that week, triggered a taxable event he hadn't planned for, and spent the next 2 months quietly furious at himself in a way he couldn't fully explain to anyone. The money was there. He just couldn't get to it cleanly. And in that moment, he realized something that no one had ever explained to him directly. Having investments is not the same thing as having financial security. Not even close. Does your emergency fund actually exist, or is it just buried inside your brokerage account right now? Drop a comment below. I read every single one. This distinction sounds obvious when you say it out loud, but the financial world spends almost zero time explaining it, because the financial world profits when you invest, not when you save. So the message you absorb from every personal finance influencer, every investing app notification, every article about compound interest is simple and relentless. Get your money working for you. Don't let cash sit idle. Time in the market beats timing the market. Invest early, invest often, invest automatically. None of that advice is wrong, but it's dangerously incomplete. And the gap between that advice and the full truth is where a lot of otherwise smart, disciplined people quietly wreck themselves. Let me explain what actually happens when you invest before you're ready. The financial industry has a term for selling investments at an inopportune time. They call it forced selling. It's exactly what it sounds like. You don't sell because you want to. You sell because you have to. An expense arrives, a job disappears, an emergency materializes, and you need cash. Right now. Not in 3 months. Not after the market recovers. Now. And whatever your portfolio happens to be worth on that particular Tuesday morning is what you get. Forced selling is the silent destroyer of long-term wealth. It's not dramatic. It doesn't make headlines. It just quietly eats through years of compounding at the worst possible moments. You buy it patience, you sell it panic. The math never recovers cleanly. If you've ever sold an investment because life happened and not because you wanted to, you already know exactly what this costs. Like this video, so more people stop making the same mistake. But here's the part nobody talks about. Forced selling isn't just a financial problem, it's a psychological one. When you know even subconsciously that your investments are also your emergency plan, you cannot hold them with confidence. Every market dip carries a different weight. A 15% pullback isn't just a paper loss you can rationally wait out. It's a potential real-world catastrophe if something goes wrong next month. Your risk tolerance on paper doesn't match your actual lived experience of watching your only safety net shrink in real time. So you make worse decisions. You check your portfolio more. You feel the volatility more acutely. You're more likely to sell at exactly the wrong moment because the emotional cost of watching it drop is unbearable when that money represents your entire margin of safety. Researchers at the University of Chicago studied investor behavior during periods of financial stress and found that households without liquid reserves were significantly more likely to sell equity positions during downturns than households with cash buffers. The investors with cash didn't need to sell, so they didn't. They held, they waited, and when the market recovered, they were still in it. The investors without cash had no choice. They sold into the decline, locked in the loss, and spent the next 2 years watching the recovery happen without them. I break down the real mechanics of building wealth the right way every week on this channel. Subscribe now and hit the bell so the next video reaches you before it reaches everyone else. Cash before investment isn't a conservative choice. It's what makes aggressive investing actually work. Think about what cash reserves actually do for your investment strategy. They give you what professional investors call dry powder, the ability to deploy capital when opportunity presents itself rather than when your paycheck allows it. When the market dropped 34% in March 2020, it recovered to all-time highs within 5 months. That crash was one of the fastest and most violent in modern history. It was also one of the greatest buying opportunities of the past 2 decades. The people who captured that opportunity weren't the ones who had the most conviction. They were the ones who had cash available to act. Everyone else watched. Warren Buffett is worth discussing here because his advice gets quoted constantly and misunderstood almost as often. People love to cite his line about never betting against America, about time in the market, about how his favorite holding period is forever. What they forget to mention is that Berkshire Hathaway, the company Buffett has run for decades, famously holds enormous amounts of cash. Not a small emergency fund, tens of billions of dollars sitting in treasury bills, earning modest returns, doing almost nothing. Buffett has been criticized for this repeatedly. Why isn't that money invested? Why let all that capital sit idle? His answer, consistently, is that cash is a call option with no expiration date. It costs you a little in foregone returns every year you hold it. But when the moment arrives, when prices collapse and fear is everywhere and everyone else is selling, cash is the only asset that doesn't correlate with everything else going down. Cash holds its value when everything else doesn't. And that is when cash becomes the most valuable thing in the world. Thousands of people are restructuring their financial order of operations after watching this. Join the conversation in the comments. Where are you right now? Building cash or already investing? You are not Warren Buffett. But the principle scales perfectly to your life. Your cash reserve isn't lazy money. It's the option to act when acting matters most. Now let's get specific about what happens to people who skip the cash foundation and go straight to investing. Because it's not always as dramatic as Jake's story. Sometimes it's quieter and slower and more insidious. You start investing at 26, which is great. You contribute regularly, your employer matches, you feel genuinely good about the trajectory. But you have no cash reserves because every dollar you can scrape together either goes to expenses or to the brokerage account. Then at 28, you lose your job. The tech company downsizes, the startup implodes. Whatever the specific mechanism, you're out. Unemployment pays roughly 40 to 45% of your previous income in most states. It's not enough. You have bills, rent, insurance, food. The math doesn't work. So you start liquidating investments. You drain the brokerage account over 6 months. Then you look at the Roth IRA. Withdrawing contributions early isn't penalized, but earnings are. You do it anyway because you have no other option. 2 years later, you're employed again, and you're starting essentially from zero. You didn't just lose the money you withdrew. You lost the compounding that would have grown on top of it for the next 30 years. The true cost of that period isn't what you withdrew. It's the future value of what you withdrew, which, at a 7% average annual return over 30 years, could easily be 5 to 8 times the original amount. This is the math nobody runs when they're debating whether to build an emergency fund before investing. They calculate the returns they're missing by keeping cash. They don't calculate the returns they'll lose by being forced to sell during a crisis. Real numbers, real behavioral research, real strategies you can implement this week. That's what this channel is built on. Subscribe, and you won't have to go looking for this stuff anywhere else. The standard recommendation is 3 to 6 months of expenses in cash. That's the number you've heard. It's a good number. But for people who are simultaneously trying to build investment portfolios, there's a more precise way to think about it. Your cash reserve needs to cover 2 different things. First, it needs to cover genuine emergencies. Job loss, medical events, major repairs, things that arrive without warning and require immediate response. For this, 3 months of actual expenses is a reasonable floor, not income. Expenses. What does it actually cost to keep your life running each month? That's the number you multiply by 3. Second, your cash reserve needs to be large enough that you can hold your investments through a downturn without being forced to sell. This is the number most people never calculate. How long could a market correction last while you simultaneously need to cover your life? The average bear market lasts approximately 9.6 months from peak to trough. Some last longer. The 2008 financial crisis lasted 17 months before bottoming out. The dot-com crash stretched to nearly 30 months. If your cash reserve only covers 3 months and a downturn lasts 18, you will sell your investments at some point during that downturn. It's mathematical inevitability. Build the reserve large enough to survive the realistic worst case, not just the convenient average. 9.6 months average. 30 months in 2001. How many months can your current setup actually survive? Run that number tonight and put it in the comments. I want to see where people actually stand. For most people, this means 6 months of expenses is the actual functional minimum, not a conservative goal, a minimum. Here's where the counter-argument comes in, and it's a real one, worth taking seriously. Every month you keep money in a savings account instead of the market, you're paying an opportunity cost. High-yield savings accounts currently offer around 4 to 5%. The S&P 500's historical average annual return is approximately 10%. Over 30 years, that gap compounds into a significant difference. Isn't delaying investment to build cash reserves actually the more expensive choice? This argument sounds rigorous. It isn't. It contains a hidden assumption that makes the entire analysis wrong. The assumption is that your investments will follow the historical average return in a smooth, predictable line. They won't. Markets don't deliver 10% per year like clockwork. They deliver negative 20% one year, positive 30% the next, flat for 3 years, then a record run. The average is real. The path to that average is chaotic, and the chaos is exactly when your cash reserves matter most. The opportunity cost calculation only holds if you never need the money during a bad stretch. The moment you need to sell during a downturn, the opportunity cost framework collapses entirely because you're now comparing a guaranteed 4% against a negative 30% with a locked-in loss. The math inverts. The cash reserve doesn't look expensive anymore. It looks like the only smart decision you made. There's also a second hidden assumption, that building cash reserves and investing are sequential choices that happen in isolation. They're not. You can do both simultaneously. You don't have to fully fund your emergency reserve before contributing a single dollar to investments. You can split the difference. Put 60 or 70% of your monthly savings capacity toward cash reserves until you hit your target. Put the remaining 30 to 40% toward investments. You get market exposure during the accumulation phase. You build the cash foundation at the same time. And once the foundation is complete, you redirect the full savings capacity to investments. The point isn't that cash is better than investing. The point is that cash is the foundation that makes your investing actually hold up under real-world conditions. Next video, I'm going to walk through exactly how to calculate your real cash target number based on your actual life, not a generic formula. Subscribe so you catch it the moment it drops. Now let's talk about what changes psychologically once you have the cash foundation in place, because this is the part that's almost impossible to fully convey until you experience it. When Jake finally rebuilt his cash reserve, after that transmission repair forced him to confront the gap in his financial setup, he noticed something strange. He stopped checking his portfolio as often. Not because he cared less, but because the daily fluctuations stopped feeling threatening. A 3% drop on a random Wednesday used to create a low-grade anxiety he carried through the day. After he had 6 months of expenses sitting in a high-yield savings account, that same 3% drop was just information, not a threat, just data about what the market was doing. He held his positions through a 9% correction that fall, didn't sell a share. Not because he had perfect discipline or superior emotional control, simply because he didn't need to sell. The need was gone. And without the need, the panic never arrived. He watched the market recover 3 months later with a quiet satisfaction that felt completely different from the nervous hopefulness he used to carry when his investments were his only cushion. That shift Jake felt from checking his portfolio every day in anxiety to just not needing to, that's what we're building toward. If you want more of this, subscribe. It genuinely changes how you think about money. This is what financial security actually feels like, not the number in an account, the psychological state that number enables, the removal of urgency from your financial decisions, the ability to wait, the ability to hold, the ability to let time do what it's supposed to do without your own circumstances, forcing you to interrupt it. The financial industry measures success in returns, but returns are only what you capture. The gap between the return the market delivered and the return you actually captured in your own account is determined almost entirely by your behavior during the hard periods. Your behavior during hard periods is determined almost entirely by whether financial pressure forced your hand. Cash reserves eliminate the forced hand. That's the entire argument. There's one more dimension that gets almost no attention. Cash before investment doesn't just protect your portfolio. It changes how you invest in the first place. When you know your emergency fund is fully funded and your life is covered, you can genuinely tolerate more risk in your investment portfolio. Not theoretically, actually. You can hold a higher equity allocation because you know you have runway. You can invest in more volatile assets because the volatility won't force a sale. You can take a longer view because your shorter-term life doesn't depend on what the portfolio does next year. Counterintuitively, the safest financial move you can make is building a large cash reserve, because that cash reserve is what allows you to take every other financial risk from a position of actual strength rather than disguised vulnerability. Jake figured this out at 31 and spent the next 6 months restructuring his entire approach. He sold down some of his taxable investments, built a 6-month cash reserve in a high-yield account, and then resumed investing with a clearer strategy and a calmer mind. He didn't lose ground by doing it. He gained something harder to quantify. The difference between investing because you can afford to and investing because you're hoping it works out. The path is not complicated. Calculate your actual monthly expenses, the real number with nothing excluded. Multiply by 6. That's your target. Open a high-yield savings account that is not connected to your primary checking account. Make it slightly inconvenient to access. Automate a monthly transfer and leave it alone until it hits the target. While you're building it, you can still invest a portion of what you save. You don't have to stop entirely. Just direct the majority toward cash until the foundation is solid. Once it's solid, the entire rest of your financial life gets easier. Investing feels different. Negotiations feel different. Career decisions feel different. The specific dollar amount in the account matters less than what it represents. The option to wait, the option to hold, the option to say no, the option to act when it matters rather than react when you have no choice. You don't invest your way to financial security. You cash your way to financial security. Then you invest your way to wealth, in that order, not the reverse. That's the part nobody explains. If that reframing just changed something for you, share this with one person who needs to hear it, not a mass share. Just one person you know who's putting money in the market right now without a real cash foundation underneath it. That one conversation could save them years.